In modern corporate America, one of the most overlooked economic distortions lies in something most employees appreciate deeply: employer-paid health benefits. But what if this well-intentioned perk is masking a far more complex and costly truth? Warren Buffett has long argued that invisible costs are more dangerous than visible ones because they make people feel safe while slowly draining resources. Health benefits fall squarely into this category. When you're not writing the check yourself, it's easy to believe that you're not really paying for it. But the money is coming from somewhere, and Buffett believes it's changing the way we think about compensation, productivity, and even fairness. Imagine sitting in a doctor's office. You're not wondering how you'll afford the treatment, because your employer covers it. But that same treatment might cost your company $10,000 to $15,000 per year per employee. If that cost were instead deposited in your bank account, would your choices and perceptions be different? This invisibility of cost, Buffett argues, is reinforced by the tax system. When a company pays for your health coverage, it gets a tax deduction. But if you pay for it yourself, you don't. So not only are you shielded from seeing the true price, you're also penalized if you ever try to take control of it. A system built to hide reality. In Buffett's words, the U.S. tax system was a stroke of genius from the government's perspective. Why? Because of withholding. Instead of Americans writing a large tax check every April, the money disappears gradually from each paycheck. The emotional sting is removed. The tax burden is forgotten. Now imagine if people had to sit down every April and write one giant check for all their withheld taxes. Public perception of taxation would change overnight. There would be outrage, demand for transparency, and a push for reform. But by hiding the costs in plain sight, the system keeps people calm and complacent. Healthcare, Buffett argues, operates under a similar veil. The actual cost is real. It's massive. It's growing. But the perceived cost is muted by employer involvement and tax incentives. And that distortion is one reason the United States spends 17% of its GDP on healthcare, while no other developed country exceeds 11%. More money, worse results. What makes this so troubling is a disconnect between spending and outcomes. In the COVID-19 pandemic, the United States recorded a far higher death rate per capita than most developed countries, despite spending more money on healthcare than any of them. The conclusion? We're spending more and getting less. Buffett doesn't mince words. He once said, "We were fighting a tapeworm in the American economy, and the tapeworm won." The tapeworm is a metaphor for the bloated, inefficient, and deeply embedded cost structure of U.S. healthcare. It consumes resources, slows productivity, and escapes direct confrontation because it hides behind a wall of bureaucracy and emotional appeal. Even when well-intentioned efforts are made to reform the system, Buffett and Munger have learned that people are resistant to losing what they don't realize they're already paying for. It's incredibly hard to convince someone to give up an invisible benefit, even if the alternative would benefit them more in the long run. Why mythology is so dangerous in business. This leads to another Buffett insight. Every organization builds its own internal mythology, and over time, those myths become liabilities. Buffett has seen it in countless boardrooms. A CEO starts saying something repeatedly to analysts. The investor relations team supports the narrative. Over time, it becomes part of the company's official story, regardless of whether it's still true. Successive CEOs continue repeating it, not wanting to contradict their predecessors or shake investor confidence. Eventually, no one remembers the origin of the claim, but it's repeated so often that it becomes unchallengeable. Even if the market reality has shifted, even if the company is drifting in the wrong direction. Buffett doesn't name names, but he admits these organizational fictions are widespread, and they're not exclusive to business. They show up in education, government, and even personal beliefs. Charlie Munger puts it more bluntly, quoting actor Sir Cedric Hardwicke, "I have been a great actor for so long that I no longer know what I truly think on any subject." It's a perfect summary of what happens when repetition replaces reflection. Leaders say the same thing so often, they forget what they actually believe. And subordinates, unwilling to challenge authority, fall in line. This leads to strategic drift, missed opportunities, and, eventually, failure. The illusion of certainty. Buffett and Munger warn against believing your own PR. When corporate leaders spend more time managing perceptions than reality, they create dangerous blind spots. It becomes harder to admit error, to pivot, or to allow fresh thinking to surface. In today's hypervisible CEO culture, fueled by quarterly earnings calls, media appearances, and social media, makes it even worse. Leaders feel pressure to always appear confident. But confidence without intellectual humility is a trap. Worse yet, successors often inherit the myths. A new CEO doesn't want to invalidate their mentor or upend the narrative investors have grown comfortable with, so the mythology continues and becomes institutionalized. The real solution? Foster environments where people can challenge narratives, where truth is more valuable than consistency, and where long-term thinking outweighs short-term performance theater. As we head into part 2, we'll explore how Buffett's view of risk evolved in a world dominated by complexity, how insurance teaches unique lessons about probability, and why being able to move quickly in a crisis is one of Berkshire Hathaway's hidden superpowers. Before we move on, though, here's something to reflect on. What's one belief about your own career, company, or finances that might be more myth than truth? Leave a comment below with what you've uncovered, because sharing that insight might spark change for someone else who's still repeating the script without question. While most investors talk about risk in terms of numbers, volatility, beta, standard deviation, Warren Buffett talks about people, specifically the people who run businesses. In his view, the greatest risk a company can face isn't found on a spreadsheet. It's sitting in the CEO's chair. Buffett has said it countless times. The number one threat to any organization is poor leadership, not market crashes, not inflation, not regulation, but placing the wrong person in charge and then keeping them there because they're nice, charming, or simply hard to replace. The quiet catastrophe of bad leadership. The irony? Bad CEOs often don't look like threats. They're well-spoken. They show up on time. They make investors feel safe. They may even be good-hearted people doing their best. But if they don't understand a business, make poor capital decisions, or simply can't adapt, the damage compounds silently. Boards, Buffett warns, are often complicit. Directors earn hundreds of thousands of dollars per year, enjoy elegant retreats, and rarely feel urgency to rock the boat. And when a CEO asks for more compensation, more time, or more autonomy, few object, especially if performance is just good enough to avoid scrutiny. But time is the enemy. A bad CEO can steer a business into ground over 5, 10, or 15 years. By the time someone sounds the alarm, the business may be too far gone. That's why, at Berkshire Hathaway, succession planning and cultural integrity matter more than quarterly results. Buffett knows a company's future doesn't depend on stock price forecasts. It depends on preserving the culture and empowering the next leader to uphold its core philosophy, the myth of predictability. Buffett is quick to dismiss long-term projections as exercises in storytelling. He doesn't believe board meetings should be filled with theoretical scenarios about 2050 or speculative risks with no immediate relevance. The real focus, he argues, should be on today's leadership, accountability, and adaptability. That's not to say macro risks don't matter. Changes in antitrust laws, tax policy, or market structures can impact Berkshire. But spending hours debating hypothetical regulation changes often becomes a distraction from the one risk that truly matters: human error at the top. In Buffett's words, the biggest risk a board has is if you pick the wrong CEO. Having served on more than 20 corporate boards, Buffett has seen firsthand how difficult it is to remove a bad leader once they're in place, especially if they're beloved, charismatic, or simply not offensive enough to confront. That's why Berkshire puts a premium on simplicity, clarity, and internal truth-telling, not performance theater, not noise. Insurance, the classroom of reality. If there's one industry that teaches brutal honesty about risk, it's insurance. And Berkshire Hathaway is one of its most respected players. After events like 9/11, Buffett recalls moments when corporations needed massive insurance coverage fast, within days. He remembers Cathay Pacific being told they couldn't land in Hong Kong unless they had new insurance coverage by the following Monday. And Berkshire delivered. They insured landmarks like the Sears Tower in moments when nobody else had the capital, confidence, or clarity to do so. Why? Because Berkshire can write the check, and the check clears. That trust is rare and valuable. But Buffett laments that this kind of urgency and demand isn't as common today. The modern insurance environment is saturated with competition, regulatory complexity, and slower decision-making. The quick-move superpower that once set Berkshire apart is now needed less often, but remains a strategic asset in uncertain times, when risk isn't obvious. The COVID-19 pandemic exposed another critical insight. Risk is rarely what we expect it to be. For years, insurers understood that pandemics were a risk, but they calculated it as something that might happen once every 100 years. And when pricing policies for events like the Olympics or the Super Bowl, they factored in earthquakes or terrorism, not pandemics. The result? Massively underpriced coverage. When the 2020 global shutdown happened, insurers discovered they had accidentally covered risks they hadn't fully accounted for, and clients suddenly interpreted vague policy language in ways the insurers never anticipated. Even worse, some insurers didn't realize what they were on the hook for until after the claims arrived. In Buffett's words, this wasn't even a worst-case scenario, and yet the economic impact was staggering. The industry hadn't done a good enough job of correlating risk across portfolios, and now it's paying the price. Literally, the silver lining? Insurers are becoming smarter, more cautious, more precise in their language, and more honest about the true return intervals of rare but catastrophic risks. Why some risks are too big to insure. Of course, some risks can't be priced at all. Nuclear risk, for instance, is simply too massive. The potential damage is incalculable, and no private company can underwrite it responsibly. That's why governments step in. In the U.S., federal authorities recognized early on that the private insurance industry couldn't carry the financial burden of a nuclear event. And they were right. The same principle applies to certain forms of systemic risk, like global cyber attacks, climate shifts, or currency collapse. These are the kinds of events where traditional insurance breaks down, not because they're unlikely, but because the potential payouts exceed the system's capacity. Berkshire, however, has shown that with enough liquidity, judgment, and courage, even massive risks can be assessed, priced, and assumed, if the timing and information are right. But that doesn't mean you should chase these risks. As Buffett says, just because you can doesn't mean you should. Risk management is about restraint, not bravado. The real danger of unseen exposure. Even the best-run companies can find themselves exposed in ways they never intended. And the scariest thing? You usually find out after it's too late. Buffett recalls cases where insurers unintentionally covered losses that were technically outside the scope of their policies, but courts sided with claimants anyway. Why? Because the policy language wasn't airtight, or because the judge interpreted ambiguity in favor of the policyholder. That's why Buffett and Munger insist on clear thinking, careful language, and underwriting discipline. The same applies to life and business. If you don't understand what you're really agreeing to, you might wake up one day holding liabilities you never saw coming. As we move into Part 3, we'll explore Buffett and Munger's reflections on organizational culture, misguided beliefs, and why modern myths inside corporations are more dangerous than external threats. We'll also touch on how humility, simplicity, and truth-telling form a foundation of Berkshire's enduring resilience. Before we do that, here's something worth pausing for. If you've ever seen a business or a person suffer because of an overlooked risk, share that story in the comments. The more we learn from each other's blind spots, the stronger we become as a community. There's a quiet kind of poison that seeps into organizations, not through fraud, not through failure, but through myths. Stories repeated so often that nobody questions them anymore. And Warren Buffett sees this as one of the greatest, least discussed dangers in corporate life. He calls it organizational myth-making. And unlike market crashes, recessions, or competition, this danger comes from within, the trap of repeating the script. It starts innocently. A CEO shares a narrative, perhaps during a quarterly call, an annual letter, or a media interview. Over time, this narrative becomes a kind of dogma. It's repeated in investor meetings, echoed by analysts, reinforced by the board. Even the company's own employees begin to believe it as unshakable truth. But what happens when that story stops being accurate? According to Buffett, very few people inside a company will challenge the official narrative. No one wants to be the person who contradicts the CEO. No one wants to raise their hand and say, actually, that's not working. And so the story continues, unchallenged, untested, and increasingly unmoored from reality. Eventually, decisions are made based on the myth, not the facts. Investments are justified based on beliefs, not data. And entire strategies are built on outdated assumptions. Why CEOs can't afford self-deception. Buffett shares a telling observation. Today's CEOs speak out more than ever. Social media, interviews, conference calls, they're always on stage. But the more they speak, the more they have to remain consistent. And the more they stick to their script, the harder it becomes to change course, even when new information demands it. Over time, CEOs may lose sight of what they really believe. They begin to believe their own mythology. Buffett once quoted a British actor, Sir Cedric Hardwicke, who said, "I've been a great actor for so long that I no longer know what I truly think on any subject." That's exactly what happens in companies where performance takes a back seat to appearances. Charlie Munger agrees. He's seen it firsthand. CEOs surrounded by yes-men, protecting an image rather than confronting uncomfortable truths. Munger doesn't mince words. He calls it a disease. In their view, the cure isn't more PR or more complexity. It's radical honesty. It's letting go of the myth when it no longer serves. It's being willing to say, we were wrong. Let's do better. Institutional memory versus institutional delusion. One of the toughest questions in leadership is this. Can the next CEO admit the previous one was wrong? Buffett believes that in many cases, they can't. There's too much loyalty, too much legacy, too much fear of backlash. So even when a company is on the wrong track, new leaders often continue the same course, just faster. Instead of correcting the mistake, they double down on it. And that's how myths become institutionalized. A false belief becomes part of the company's DNA. And no one wants to be the one to say the emperor has no clothes. It's not just a business problem. Buffett sees this across education, government, and media. It's part of the human condition. People would often rather be consistent than correct. But Berkshire Hathaway has tried to do it differently. They build a culture where course correction is not seen as weakness. It's seen as wisdom, a culture of truth. At Berkshire, there's no chief marketing officer spinning glossy narratives. There's no obsession with quarterly earnings. And there's no pressure to tell investors what they want to hear. Instead, Buffett and Munger speak candidly. Even when the truth is uncomfortable, they talk about failures just as openly as they talk about wins. They admit when they've changed their minds. And they never pretend to know things they don't. That kind of culture doesn't happen by accident. It requires humility. It requires courage. And most of all, it requires a system that rewards truth over performance. Buffett doesn't believe in having a strategy for every possible future scenario. He believes in having a culture that's resilient enough to handle whatever comes. Preserving that culture. As Buffett ages and Berkshire prepares for future, one question looms larger than all others. How do you preserve that culture once he and Charlie are gone? It's not a small question. Berkshire isn't just a collection of businesses. It's a philosophy, a way of thinking, a moral code wrapped in a corporate structure. And it's fragile. Buffett says the biggest risk isn't a change in laws, taxes, or technology. It's choosing a leader who doesn't get it. A leader who wants to play Wall Street's game. Who values praise over performance. Who says the right things but doesn't mean them. To prevent that, Buffett and the board have emphasized succession planning, cultural fit, and values alignment over resume polish or charisma. They want a CEO who leads with conviction, not showmanship. Because Berkshire's greatest asset isn't Geico or BNSF. It's not cash or equity. It's trust. And that can't be measured on a balance sheet. The final lesson. When you zoom out, this is the essence of Buffett's worldview. Be honest. Stay simple. Avoid myths. Think long-term. And never bet on charisma over character. Whether in investing, leadership, or personal growth, the message is the same. Truth is the ultimate advantage. And those who cling to it, even when it hurts, are the ones who endure. So if you've ever watched a leader fall into the trap of their own myth, or if you've seen a company recover because someone finally spoke the truth, share your insight. Let others learn from it. Your comment might be exactly what someone else needs to hear today.